In previous webinars, I have said that technical analysis or charting can be divided into three major sections. The first is trend lines and formations, which we have discussed. The second is line charts and the indicators that go with those line charts. And the third is the wave and cycle theories. Now in this webinar, we're going to discuss the simplest indicator on all line charts that can be used with all line charts, and that is the moving average. Now your objective is to find and buy shares when they're cheap and to sell them when they're expensive. And the moving average technique will guarantee that you can do that. This is how it works. Suppose that you have a share which is trading in the market for 2,000 cents, and it's in a downward or bear trend, and it falls to 1,900 cents, and then to 1,850, and then to 1,600, and to 1,500, to 1,450, 1,300, 1,150, 1,100, 1,000, and that's where it bottoms, and then it turns and it starts to go up, and it goes to 1,050, then back to 1,100 cents, then to 1,250, to 1,300, and all the way back up to 2,000 cents. Now, if we drew a graph of that, it would look something like this. And of course, your objective is to find and buy the share at or close to this bottom point at 1,000 cents. And as I said earlier, the moving average will guarantee that you can do that. Now, to calculate the moving average, what we do is we take an average of these 5 prices. In other words, we add them up and we divide by 5. And if we do that, we will get 1,770 cents. And we plot that 1,770 on the same day as we plot this 1,500. Now the next day, when we get the next day's price, we leave off the oldest price and take in that newest price and again divide by 5. Now because we're leaving off 2,000 cents and we're taking in only 1,450, our average will of course drop, and it drops to 1,660. And again, we plot this 1,660 on the same day as we plot this 1,450. So here's your 1,450 and here's your 1,660. And each day we do exactly the same thing, sliding the average down the column of figures as we get each new day's figures, leaving off the oldest one, taking on the newest one, adding them up and dividing by 5. And you will see that when you plot this on your graph, it looks something like this. The moving average will follow the price down but remain above it until, of course, we reach this bottom point here, at which stage the moving average will persist down for a while because it carries with it the downward momentum of the previous 5 days. And then eventually, of course, it will cross over the line here, the share price, and start upwards, following the share price up but remaining on the underside. And then basically at the top you'll get the same thing. The share price will turn and start falling, but the moving average will persist upwards for a while, crossing over the share price line. And basically it's as simple as that. This here is your buy signal, and this here is your sell signal. So that is the method. That is how a moving average is calculated and plotted on your charts. In our example, we used a 5-day moving average, but in fact you can use any length of moving average that you want to. So you can have a 10-day moving average, a 20-day moving average, a 500-day moving average if you want to. So if you had, for example, a 200-day moving average, you would add up 200 days of data and divide by 200 each day. And then as you got each new day's price, you would add it in and take off the oldest price, so always keeping 200 days in your moving average. Now longer moving averages tend to be smoother and to stay further away from the price chart. They will give you much later signals, both on the buy and the sell. A short moving average will cut your price much more quickly and so give you a better signal, an earlier signal, but it will get entangled in sideways movements. Now let us consider an example from the actual market. Look at this chart. Here you can see the JSE Gold Index with a 200-day moving average in red and a 30-day moving average in green. Notice how the shorter 30-day moving average follows the index much more closely than the 200-day moving average and gives far more signals, both buy and sell. The 30-day moving average also gives its signals much earlier than the 200-day moving average, as you can see here and here. Now look at this chart of the JSE Gold Index with a 300-day moving average superimposed. You can see that there was a clear buy signal here and a sell signal here, and then another buy signal over here. Notice also that the moving average buy and sell signals do not get you in right at the bottom of the trend over here or right out at the top here. But the moving average does help because it does not get you out of the upward trend in these two corrections, over here and over here. You can see that the moving average smooths out the graph to reveal the underlying trend. It eliminates the short-term fluctuations or noise in the chart. The problem with moving averages is that they do not help you during a sideways market, where the index is moving up and down, backing and filling within a narrow trading range. Consider this chart of the JSE Gold Index from 1998 to 2001. Here you can see that for a number of years the index moved up and down within a narrow trading range, causing it to cross and recross its moving average and giving many buy and sell signals at more or less the same price. In a sideways market, you can be whiplashed buying and selling repeatedly, which of course only makes your stockbroker rich. So moving averages have a number of problems. They do not get you in right at the bottom and out right at the top. They will not get you out at the beginning of a correction and then back in when the correction ends. And they will not help you in a sideways market, as we have just seen. But they are very, very useful indicators, and they work extremely well. A study in the United States of America using the Dow Jones Industrial Index over the past 110 years shows that with that index, if you had applied a 200-day moving average and bought in on every buy signal and sold out on every sell signal, you would have done 10 times as well as another investor who simply bought at the beginning and held the index through to the end of that period. So moving averages definitely work. The question really is, why do they work? The reason that they work is that they exploit a particular human behavioral characteristic. They exploit the fact that people have a great deal of difficulty in adjusting their perceptions of the value of an asset quickly. If I told you that your house was worth nothing, you would have a great deal of difficulty in accepting that, even if I was right. The most traumatic experience we can have is to write off a motor car, because what was worth 250,000 Rand a few minutes ago is now a useless heap of scrap metal. So people are socialized or brought up that assets do not change their value quickly. Let me give you an example. Suppose that you were holding a share which was trading for 20 Rand in the market today. Would you sell it tomorrow morning for 1 Rand? Definitely not. Nor would anybody be stupid enough to offer you 1 Rand. But if it was overpriced at 20 Rand, it's quite conceivable that tomorrow morning you might accept 19 for it. And in fact, if you were still holding it the day after that, you might accept 18. And it might eventually reach 1 Rand. But it would never do so in one day. And that means that mathematically, it must cut down through your moving average, and you will always have time to sell. So you can see that the moving average technique, like all indicators in the stock market, exploits a particular human behavioral characteristic. Because technical analysis is really a social science, like economics or psychology. It examines a particular human behavioral characteristic. And each indicator can be and should be linked back to the behavioral characteristic that it exploits. Consider this chart. Here you can see the S&P 500 index from Wall Street over the past 15 years, together with a 300-day moving average. Notice how the moving average clearly shows the major bull and bear markets over that period. And this is one of the most useful applications of a moving average. It can tell you when the markets of the world are in a bull market and when they are in a bear market. All you have to do is to look at the slope of the 300-day moving average. If it is rising, it means that the 500 largest companies trading on the New York Stock Exchange are rising. And that almost certainly means that the stock markets of the world are in a bull trend. The opposite is also true. So, let us sum up then. The difficulty which people have in adjusting their perceptions of the value of an asset quickly causes the share market to move in broad sweeping trends. And to the extent that it does that, the moving average will work and give good signals. And to the extent that it does not do that, in other words during a sideways market, the moving average will not work.